Are you ready to elevate your dividend investing game and potentially outperform one of the top ETFs, SCHD, in 2024? If so, let's take a look at the SVOL ETF. This high-income fund has recently made significant changes to boost its performance. With market volatility rising and the VIX chart jumping 45% in just a few weeks, SVOL's strategy of selling options on volatility futures is more compelling than ever. Not only does it offer a hefty dividend yield, but its unique approach sets it apart from other high-income ETFs like JEPI. By understanding these strategies and recent adjustments, you can better position yourself to surpass benchmarks like SCHD in 2024. So, stick around as we explore SVOL's performance, asset allocation, market conditions, and investment strategies for superior returns. Let's get started. SVOL, the Simplify Volatility Premium ETF, is a unique high-income ETF that stands out for its innovative approach to generating dividend yields. This fund has garnered attention for its exceptional performance and distinctive strategy that sets it apart from traditional dividend ETFs. Understanding the intricacies of SVOL is crucial for investors looking to maximize their income potential while managing risks effectively. Recent changes and improvements in SVOL has made it even more attractive to investors. One significant update is the fund's enhanced strategy to capitalize on market volatility. By refining its approach, SVOL now offers a more robust mechanism for generating income, ensuring that it can deliver high yields consistently. Additionally, the fund managers have made strategic adjustments to the portfolio composition, reducing exposure to certain risk factors while optimizing for better returns. These improvements reflect a proactive approach to navigating market conditions and enhancing the fund's overall performance. A core component of SVOL's strategy is selling options on volatility futures. This involves taking positions that benefit from stable or decreasing volatility in the market. By selling options on VIX futures, SVOL effectively bets against significant spikes in market volatility. The premiums collected from selling these options are distributed to investors as dividends. This approach is similar to selling call options on stocks, but applied to the volatility index, providing a steady stream of income as long as volatility remains within expected ranges. This method not only generates substantial dividends, but also offers a hedge against market downturns, making it a powerful tool for income-focused investors. Another critical aspect of SVOL's strategy is its conservative use of assets. The fund allocates only about 20% of its total assets to the volatility trading strategy. This cautious allocation is designed to protect the fund from extreme market events that could lead to significant losses. By limiting the portion of assets used in high-risk strategy, SVOL ensures that it can withstand sudden spikes in volatility without jeopardizing the entire portfolio. This approach contrasts sharply with other volatility-based ETFs that have failed in the past due to overexposure to volatility trades, highlighting SVOL's better risk management. Now, let's have a look at its performance and see how it's performed since it started. Well, SVOL has demonstrated notable performance since its inception, especially when compared to major benchmarks like the S&P 500 and other popular high-income ETFs. The fund has consistently outperformed other ETFs, providing investors with superior total returns. Since its launch, SVOL has delivered a total return of 31.5%, including dividend distributions. This figure surpasses the 26.1% return of JEPI and many other high-income ETFs. showcasing its effectiveness in generating significant income and capital appreciation. One of the standout features of SVOL is its ability to maintain a consistent dividend yield. The fund regularly distributes dividends, providing investors with a reliable source of income. Typically, SVOL distributes around 30 cents to 32 cents per share each month, which translates as an impressive dividend yield of approximately 17.7%. The fund's strategy of selling options on VIX futures and utilizing a portion of its assets in fixed income investments helps maintain this high dividend yield, ensuring steady income despite market fluctuations. The asset allocation of SVOL is a crucial aspect of its strategy and performance. The fund's holdings are diversified across various asset classes to optimize returns while managing risk. Approximately 50 to 60% of SVOL's assets are invested in fixed income treasuries. These treasuries provide a stable yield, contributing to the fund's consistent dividend distributions. The fixed income components act as a foundation, offering stability and reduced overall portfolio risk. This conservative approach helps safeguard the future against extreme market volatility and downturns. A significant portion of SVOL's assets, about 20%, was allocated to the Simplify Aggregate Bond ETF. AGGH invests in U.S. investment-grade bonds and employs several credit hedging strategies to enhance its yield. This primary exposure of AGGH is to the iShares Core U.S. Aggregate Bond ETF, which tracks the performance of the U.S. total investment-grade bond market. This exposure to high-quality bonds helps SVOL generate additional income through dividends. However, the performance of AGGH is closely tied to interest rate movements, as bond prices generally have an inverse relationship with interest rates. Interest rates have a significant impact on SVOL's performance, primarily due to its exposure to fixed income assets and AGGH. When interest rates rise, bond prices typically fall, exerting downward pressure on AGGH and, consequently, on SVOL's performance. On the other hand, when interest rates decrease, bond prices tend to rise, boosting the performance of AGGH and SVOL. For example, in 2021, as interest rates were cut, AGGH performed well, contributing positively to SVOL's overall returns. However, in 2022, as interest rates began to rise, AGGH's performance suffered, negatively impacting SVOL. In response to changing interest rate environments, the fund managers of SVOL have made strategic adjustments to its asset allocation. Recently, they reduced the exposure to AGGH by 50%, cutting it down to 10% of the fund's total assets. This move was prompted by the anticipation of higher interest rate hikes for a longer period, which could adversely affect bond prices. By decreasing exposure to AGGH, the fund managers aimed to mitigate the potential negative impact of rising interest rates on SVOL's performance. Instead, they increased the allocation to a more stable income ETF, BUCK, which focused on very short-term fixed income investments. This shift helps protect the fund against interest rate volatility and provides a safer, more stable yield. SVOL's ability to adjust its asset allocation in response to market conditions and interest rate expectations demonstrates the proactive management of the fund. These adjustments are crucial for maintaining the fund's performance and protecting investors' capital. By balancing exposure to high-yielding bonds with more stable fixed income investments, SVOL can continue to deliver attractive returns while managing risk effectively. Now, talking about risks, let's take a look at SVOL's exposure. Investing in high-yield dividend ETFs like SVOL comes with its own set of risks and considerations. Geopolitical risks and inflation concerns are two significant factors that can impact the performance of such investments. Geopolitical tensions, such as conflicts in the Middle East or trade disputes, can lead to increased market volatility. These events can cause rapid shifts in investor sentiment, leading to sudden sell-offs or spikes in volatility indexes like the VIX. For SVOL, which relies on selling options on volatility futures, such spikes can pose a risk to its income-generating strategy. Inflation concerns are equally important. Persistent inflation can lead to higher interest rates as central banks try to control price increases. For bond-heavy ETFs like SVOL, rising interest rates can result in declining bond prices, negatively impacting the fund's performance. Investors need to be aware of inflation trends and how they might influence interest rate policies. Keeping an eye on economic indicators such as the Consumer Price Index and central bank announcements can provide valuable insight into future inflation and interest rate movements. When comparing SVOL to other high-yield dividend ETFs like SCHD, it's essential to understand the differences in strategy and performance. SCHD, the Schwab U.S. Dividend Equity ETF, focuses on high dividend-yielding stocks and aims for long-term capital appreciation. In contrast, SVOL employs a more complex strategy involving options on volatility futures and fixed income investments. While SCHD provides a more straightforward approach to dividend investing, SVOL offers higher yields but comes with additional risks due to its reliance on volatility strategies. Understanding these differences helps investors make informed decisions based on their risk tolerance and investment goals. SVOL's unique approach can result in higher yields, but also requires a deeper understanding of market dynamics and the ability to manage the associated risks effectively. One of the most important tips for investing in high-yield dividend ETFs is to stay informed. Keeping up with market news and economic reports can provide valuable insights into potential market movements. Investors should also consider using research platforms and tools to analyze the performance and strategies of different ETFs. Platforms like Seeking Alpha and Koifin offer in-depth analysis and data that can help investors make informed decisions. So, what's the future outlook for SVOL? It might be promising. Interestingly, the future outlook for the SVOL ETF hinges on several key factors, most notably the potential for rate cuts and subsequent market reactions. As central banks globally grapple with economic growth and inflation, their monetary policies will play a pivotal role in shaping market dynamics. Currently, there is growing speculation that the Federal Reserve might implement rate cuts to stimulate economic activity. Should this occur, it could have significant implications for SVOL and similar ETFs. If rate cuts are implemented, the bond markets are likely to rally. Typically, lower rate increases bond prices because existing bonds with higher yields become more appealing to investors. This inverse relationship between rates and bond prices suggests that SVOL's fixed income investments, especially those in the Simplify Aggregate Bond ETF, could experience significant gains. AGGH, which invests in high-quality bonds and employs credit hedging strategies, would benefit from a bond market rally, boosting SVOL's overall performance. The anticipation of rate cuts has already started to influence market sentiment, and actual implementation would likely solidify these trends. So, looking forward, SVOL's expected performance in future market conditions appears promising, especially if the anticipated rate cuts come to fruition. The combination of a bond market rally and reduced volatility could create a highly favorable environment for SVOL. Investors can expect the ETF to leverage these conditions to deliver strong returns. Furthermore, the broader economic context also supports a positive outlook for SVOL, as central banks aim to balance inflation control with economic growth. A more accommodative monetary policy could stimulate investment and consumer spending. This would likely lead to increased corporate earnings and, subsequently, higher stock prices. For SVOL, this means a dual benefit. Its bond holdings would appreciate in value, and the underlying equities in its portfolio could also see gains. This dual boost would enhance SVOL's total returns, making it appealing for income-focused investors seeking both stability and growth. However, it's essential to remain mindful to potential risks. While the outlook for rate cuts and bond market rally is positive, unexpected economic development or shifts in central bank policies could alter the landscape. Investors need to stay informed and agile, ready to adjust their portfolios in response to changing market conditions. So, what are your thoughts on SVOL and its innovative strategies? Do you think it has potential to outperform other dividend ETFs in 2024? Share your thoughts in the comments below, and don't forget to give this video a thumbs up if you found it helpful. Make sure to subscribe and turn on the notification bell to our channel for more in-depth analysis and investment tips.